Hi, and welcome to the Monthly Income Podcast. I'm your host, Tom Lydon, and as always, I'm joined by the co-founders of Neos Investments, Garrett Paolella and Troy Cates. Gentlemen, great seeing you.
Great to see you too, Tom. Good to see you, Tom.
Are you guys having fun with this? I mean, this is number 3. We're getting some pretty good feedback so far.
It's been a lot of fun. We've definitely seen some interest, a lot of clicks coming through, a lot of views coming. So it's been great, but just fun to be on here and just talk about really important things, I think, that help investors.
It is. In the last episode, we dove into buy right strategies. We talked about the Neos approach to options writing, and that was really good, very educational. But today we're going to get into the fun stuff. This is the Monthly Income Podcast, and income's really important, but really what separates the men from the boys is it's not what you buy, it's what you keep. So we're going to dive into taxes. And we've talked about how income is generated from the options market for sure, but not all options are also created equal, and you guys are going to talk about that a bit. The yield or the distribution rates you see and how things are reported isn't always what you get to keep, right? And so from a tax efficiency standpoint, Garrett, that's really important, and I don't think we talk enough about it.
Yeah, thanks, Tom. I mean, I think one thing that Neos really focuses our efforts on is what is that net after-tax income, right? Income is really important to individuals, but I think as investors, a lot of people do look at just what a gross yield or a gross distribution rate could be in a product. And so for us here at Neos, we're really thinking about how do we make sure that as much of that gross return and yield that we can generate for an investor is taken home after taxes. And so as we think about it, we're utilizing index options that are going to allow us to take in a preferential tax treatment from the IRS that basically states that 60% of the returns are taxed at long-term capital gains rates and 40% at short-term. So for us, it's really the instruments we use. It's also our investment process. So ways that we could do things like tax loss harvesting. So there's a variety of different structural ways that Neos really focuses on making sure that net after-tax return is as high as it possibly can for investors. Today,
we're going to talk not just hypothetically, but we're going to get into the actual numbers of 2024 as reported by Neos's fund accountant. And these are all the numbers that end up getting into your 1099 that you've probably already received or are about to receive as everyone's trying to get ready for tax season. Let's talk a little bit about the different types of options. And Troy, maybe you can walk us through, because this is the whole idea here. Not all options are created equal.
Yeah, this comes up a lot, Tom. I think, to follow on with what Garrett said, wherever we can, we try to use index options. And as you'll see on the screen, index options give you a preferential tax treatment from the IRS, where it states that Rule 1256 gives you 60% long-term cap gains, 40% short-term cap gains, no matter the holding period. So for a lot of the options that we trade, whether that's on a weekly basis when we're rolling or a monthly basis, you're going to have an associated P&L. So to have that preferential tax treatment of getting 60% long-term cap gains and 40% short-term cap gains makes a big difference. So when you compare that to how some others may manage their option strategies, whether that's through swap agreements, equity-linked notes are a large one, single stock options, as many people use, or even ETF options. If you look at that, a lot of those they get 100% short-term capital gains treatment. So any P&L that comes off of those option trades is treated as 100% short-term capital gains. So very different than how the index options are looked at.
All right, Troy, that was great. That's really helpful. Garrett, maybe walk us through some of the flagship ETFs. Let's start with SPYI. Walk us through the numbers for 2024 and what did they actually tell us?
As everyone's seen on the screen, one big thing that we talk about is return of capital actually as a positive, right? Return of capital historically has a negative definition, thinking that you're returning principal, the original investment. A big thing for us is ensuring that you're getting a wholesome total return in a product, but being able to convert that ordinary income short term all into a deferred long-term capital gains treatment. And so let me just walk through this one. So for 2024 for SPYI, we had a trailing 12-month distribution rate of just under 12%. But for 2024, we had a total return of just over 19%. So the fund as a whole returned 19%. And for the 2024 distribution rate of $6.11, that actually was categorized from a tax purpose of just under 94% being a return of capital, meaning we've been able to convert ordinary short-term, even long-term, into a deferred long-term capital tax rate. And the way that works is essentially the investor in that current year for that percentage that was deemed a return of capital isn't paying a tax on that percentage. It reduces their cost basis over a long period of time. And if or when they sell the fund in the future, it has now all been deferred and converted into a long-term capital gains rate. So when you think about income, right, income is really important to be earning as much as you can on a net after tax basis. And what we're able to essentially do is convert that and defer it into that long-term capital gains rate as if you just held maybe the S&P 500 for longer than 1 year. But in this case, we're distributing on a monthly basis and getting a very high degree defined from a tax purpose as return of capital, as opposed to that ordinary income where in certain, tax brackets, people are paying upwards to 50 or over 50% of that distribution out to the IRS.
So Garrett, I mean, it's not just you're not paying current income tax rates, it's deferred. You do have some tax obligations for sure. Your cost basis does decline, so eventually you're going to have to pay the tax if you do sell it, but it's long-term capital gains. And the big thing there, as we all know, the compounding effect, especially if you're holding this over time, is a game changer, right?
Yeah, that net after tax compounding effect is really meaningful for investors. And so I think one simple way of thinking about this concept is almost real estate, right? If you owned a building and you're receiving rental income, you're depreciating the value of the building against your rental income to not pay taxes. So you've converted that rental income from ordinary income into a deferred long-term capital gains. We're doing the same thing here, but you're able to take advantage of a liquid investment exposure to the S&P 500 as opposed to one individual building. And so I think that's always a good frame of reference or explanation for investors as you're thinking about, like, how does this structure really work? It's very similar to you being a landlord and owning a property or building and getting to convert that rental income from ordinary income on an annualized basis ultimately into a deferred long-term capital gains if you sell the fund in the future, unless, of course, you take advantage of estate planning and you pass these investments on, to beneficiaries that get that re-step up in basis. So the tax structuring really is an important concept to understand when you're thinking about income-oriented products and specifically, the NEO suite of products.
Yeah. Have my kids been calling you? Have they been talking to you? And geez.
They asked me not to say anything, so...
So look, return of capital can be scary sometimes, and you did a good job explaining it. We also hear the terms return of principal. Are they the same?
So they're different in the standpoint of talking about from a tax designation. Returning principal is really just returning that individual investor's investment, right? And so that's not a positive way. You should not be calling that a distribution or some type of income. Return of capital from a tax definition is really around the fact that you're deferring income and converting it from a higher tax rate into a much lower tax rate, sometime in the future.
Yeah, and we know there's so many products that are in this space that some issuers out there are kicking off some pretty big distributions, but it's coming at the expense of principal. And I know we're seeing a lot of people writing about that. That's really, really important. Troy, let's dig into QQQI and how did it do last year?
Sure. Now, QQQI had a great year last year. So total return just over 19% for the year. While we didn't have a full calendar year, we launched the product at the end of January last year. So we had a good 11 months of returns. And as far as return of capital, as you can see on your screen, just over 95% was deemed return of capital out of all the distributions that went out last year. So a good portion of that, again, as Garrett was walking through, you will defer your taxes to a later date down the road. So again, not looking to return principal as Garrett had walked through, but looking to get a tax designation of return of capital where that piece can be deferred down the road. And yes, your cost basis will go a little lower, But again, hopefully when you decide at some point to sell the product or whatever you decide to do with it, there will be more of a long-term cap gains on that sale versus an ordinary income within the year you're receiving the distribution.
All right, guys, I'm not asking for tax advice, but I've actually gone through this myself. Where can investors find these tax statements, number one? And also, where does the return of capital actually show up on the 1099 form?
So from a 1099 perspective, that's where all of this is going to be broken down. You'll see that in the summary. You'll break that out into each individual. So there's nothing you need to do from your individual perspective, in what these allocations are. Although one thing you'll notice, what I've seen on 1099s in all of my holdings and positions within our products are they really show up as, non-dividend distributions or maybe non-qualified, meaning it's not a equity dividend. It's not a qualified dividend coming in from a company distribution. And so they'll each potentially have their own designation, but there's definitions for your accountants. It's listed out there saying what a qualified distribution is, a non-qualified. And so you'll get to see that summary on the 1099 and as an individual breakout within each one of our funds.
Yeah, so it's not just the 1099 as a whole, and there you see certain income come in or distributions come in into that one box that's very favorable as opposed to normal income tax treatment. And then, as you said, Garrett, in the details, it breaks down by fund, correct?
Yes, that's correct.
When you talk about cost basis, if you hold something over time, and Troy, maybe you can tackle this, what happens if that cost basis gets down to zero because you keep chipping away at that deferred gain?
So as the cost basis comes in, because you're getting those distributions, as we were talking about, that a portion of it is considered return of capital, yes, there can be a point years down the road where your cost basis eventually hits zero. And then again, not tax advice, but as far as I understand it, you'll be paying capital gains on that. So long-term capital gains on those distributions going forward where you have that zero cost basis.
I mean, guys, this is really, really important. And I think there are a lot of investors that are diversifying and they're spreading their money around, as monthly income is really key and critical. But the tax treatment of that monthly income is even more critical. And it's going to separate the men from the boys. Hey, gentlemen, before we go, we've been getting some questions from advisors, and they pointed out both QQQI and SPYI had total return of over 19%. And the distributions were 12%, around that area. So it appears that there's still net asset appreciation. Talk about that, and how are you able to do that?
I think this is one important feature that NEOS really focuses on, and different than other potential products in the marketplace, is we want to make sure that first and foremost, we're delivering the income needs and generating that income out of the options portfolio for investors. But following that is, how do we participate with the equity underlying appreciation? And so we're really looking to marry the ability of that tax efficient income generation, with upside potential, given these are equity allocations. And so that comes just from our methodology, but it's great to see that you can generate that tax efficiency that we just spoke about and that return to capital structure. And I think helps support the fact we're talking not about a returning of principal, because you've had that NAV appreciation above and beyond, what you're getting as a monthly distribution, from that tax efficient structure.
Yeah, great, Garrett. And a great question. And listen, folks, get more questions to us. We'll try to handle them on the future podcasts. So thanks for joining us. We're going to see you next month on the Monthly Income Podcast. Garrett, Troy, thanks, guys.
Thanks, Tom.
Thanks, Tom.